Hey everyone, Joe Gentili from Left Tail Risk Advisors. So if you're the trustee of an ILIT or another type of trust that owns life insurance, then this video is primarily for you. As you are undoubtedly aware, being a fiduciary brings a whole host of responsibilities. And one of the responsibilities that you have for the trust is the life insurance policy within it, which is likely a very significant asset within that trust. And most of you are very aware that you have certain duties. You have the duty to make sure that the premiums are paid on time, that if crummy notices are involved, the crummy notices are administered properly. You also have a duty to monitor the policy to make sure that the policy is healthy and that it's on course to provide the death benefit that it's there to provide. That can be a relatively simple task if you're dealing with policies that have a lot of guarantees in them, like whole life insurance, where if you pay the premium, the policy stays in force. A lot of estate planning has been done with policy types that have less guarantees in them, like universal life insurance or index universal life insurance. And for those policies, they require policy reviews much more frequently. And as a fiduciary and as a trustee who has a duty to monitor, you have a duty to oversee that that happens correctly. I don't think that there's necessarily an expectation that the trustee is well versed in life insurance, but I do think there is an expectation that the trustee takes measures to bring in somebody appropriate who is well versed in life insurance to evaluate the health of the policy and see if any changes need to be made, whether the funding level of the policy needs to change or new coverage is needed. And so the risk that I'm focused on in this situation is premium sufficiency. That's something that I think a lot of trustees miss if you're not well versed in life insurance, because it's not something that exists in any other type of insurance and not even in whole life insurance, but it does exist in universal life insurance chassis. Premium sufficiency, what I'm basically laying out with that is that in every other type of insurance you could think of, if you pay the premium, the policy stays in force. The premium and the cost of insurance are the same thing. That is not true with universal life insurance. With universal life insurance and index universal life insurance, there's a target premium, there's a target funding. And that target funding is the amount of money that you'd have to pay into the policy every year for the policy to stay in force for life, assuming certain assumptions hold up. And those assumptions include that the interest earned in the policy or the crediting rate is performing at a certain number, that the cost of insurance is being charged in the policy at the rate that it was forecasted to be charged in the beginning, but that could also change. These things are just assumptions. And so if those assumptions are not being met, let's say that the target premium that was given on the policy was assuming that the policy is going to earn 6% a year, basically infinitum. If you're earning 5% a year on that policy on average, that may not sound like a big difference. But for life insurance policies that are held for decades, that difference in compounding, that can be the difference between a policy that stays in force for life and one that lapses during a person's lifetime, or certainly would need a very large cash infusion later on in life to keep the policy in force. And in order to avoid that problem down the line, in order to avoid this from becoming a time bomb, it's imperative that policies are reviewed on a regular basis, annually, biannually, to make sure that the policy is on course, that if the policy was funded in a way that's underperforming based off the assumptions that it was funded for, that there's corrections that are made early on, because it's much easier to address these problems early on than it is later on. And as a fiduciary, as a trustee, ultimately you have responsibility for this. If the policy is just the premium is paid and nobody's checking to see what the underlying health of the policy is and the policy lapses later on, the person, I think that people will look to for ultimate responsibility or potentially legal responsibility is the trustee. The agent that sold the policy, they're long gone. Folks involved with setting up the trust, they may be long gone, but the ongoing trustees, whether they're professional or not, they're still there. So very important to be mindful of this risk, because as a person that has litigated a lot of life insurance cases, this is a scenario that for me came up more often than any other, which is people had a universal life insurance policy. They paid for it and funded it according to how they were told in the beginning. They never checked up on to see whether that was still the appropriate amount to fund the policy. And later on, they get a very large bill to keep that policy in force later on. And either they can't afford to pay it, or they can afford to pay it, but it's not really financially feasible. It doesn't make sense at that point. And so you end up with situations where people have paid into policies for decades and end up with zero, no benefit for it. They get no death benefit. Very, very bad situation. So I strongly suggest, if you are a trustee of a life insurance trust, and especially if the type of policy that is in the trust is a universal life insurance policy or an index universal life insurance policy, have a life insurance professional review that policy to see if, with an in-force illustration, to see if as that policy is currently funded, is it still on course to stay in force for life? What are the odds that it's going to stay in force for life? And if those odds are low, if it's something that you, the trustee, are not comfortable with, then you need to have discussions about changing the funding amount in that policy or potentially getting new coverage. Another thing that a life insurance policy review can reveal is that pricing for cost of insurance is very different amongst policies, and it's not necessarily obvious from an illustration or from the premium amount that you're told to fund, which is the better priced policy. And that's something that also can be addressed with policy reviews to see if the costs that are being paid are in line with what can be gotten otherwise in the market. So very important detail, something that is very easy to overlook if you're not familiar with the mechanics of life insurance. So if you are a trustee of a life insurance policy, I strongly suggest you see what type of coverage is in there, and especially if you have universal life insurance in there, make sure that you have frequent policy reviews, annually, biannually, just to make sure that this policy is on course to stay in force for life. Any questions, please feel free to reach out. And if you found this video helpful, I really encourage you to like and subscribe. Thanks.